Real quick on the elections coming up, midterms on November 8th. This is a chart of how the stock market behaves in election years. One point is that if you just take simple averages going back to 1933, there's a trend that says midterm election year returns are lower than non-election years and presidential election years as well. But stepping back, it's probably more important to note that none of those numbers on those bars are negative. It does exclude a couple. I'll come back to that in a second. But the point is that investors are often concerned by how the stock market may perform in election years. While there is some small difference between election and non-election years, it's again not only small, but all years show positive average returns. And then even on the right-hand side there, once you exclude 02 and 08, both of which had very little to do with elections, there's a little difference between years is the point of this. And then slide on presidential elections and stocks. We're still a few years out, obviously, on this one. I think it's important to make the point, though, that analytically, it's not the case that you can point to one party or the other to make the claim that it impacts the stock market better or worse than the other guys. The data isn't there for that. To be clear, I'm not saying politics doesn't matter as taxpayers and citizens. There's no more important civic responsibility, right, than voting. There are clear differences between parties when it comes to economic and market policies. Those hours of videos could probably spend there. The question, though, is really, all right, should you adjust your portfolio based on those differences? And the answer is no, at least not. It's not justifiable by anything in the past. There's nothing in the data that would indicate that would be a good thing to do. So, continue to take elections very seriously as a citizen and taxpayer. What I'm saying is just let's not make dramatic adjustments just because you're afraid of the outcome in election. There's no real analytical case to do that in the past. You don't want it to be a distraction. You don't want it to influence your emotions, frankly, one way or the other. So just probably a little public service message given how political polarized everything seems to be getting over time here. Here is the federal budget deficit relative to GDP. You can see the U.S. has historically run a budget deficit every year, really. That deficit is just the difference between federal government revenues and expenses. That subject of deficits in particular can also invoke a lot of political beliefs and policy opinions, but from an investment perspective, it may be helpful to keep in mind this particular snapshot, really to kind of counter, at least in the mental sense, sort of the bears and the subscription newsletter peddlers who kind of regularly preach gloom and doom because of government budget deficits. To be clear, I'm a big advocate for financial responsibility in general, whether that's at home on the personal front or at the level of Uncle Sam. But again, when it comes to the specific question of whether or not you should change your investment approach to stocks because of fears about the U.S. deficit specifically, the answer here is also a pretty resounding no. There's just really no evidence from, I mean, even beyond this, there's from the last 246 years of American history, there's no evidence that the level of national debt has ever really mattered. The U.S., prints its own currency, can borrow as much as it likes. Excuse me. Get a little swig of water. Can borrow increasingly from domestic investors too. Now, there are absolutely real risks if we get too cocky about that, and that's not to say it won't matter someday. And the federal debt to GDP chart is a whole other discussion. But my point here is that the deficit just doesn't matter at the moment. We can also, for what it's worth, and I say this a little tongue in cheek, we can solve that in about 30 seconds. But hold that thought. Apologies. I like this slide. It's a reminder that really that context is important, specifically in terms of the country's monetary response to the pandemic. As you may remember, at the height of COVID panic in March 2020, we passed what was the largest single relief package in U.S. history, the CARES Act. Totaled $2.3 trillion with a T, trillion dollars. That's a hard number to imagine, just in the absolute sense. And it sounds so unfathomably large that it's natural to wonder, boy, can we afford that? And the answer is yes, because America is rich. The U.S. economy totals about $25 trillion in size, and $2 trillion of stimulus for a $25 trillion economy. It's arguably important context, and so this chart is one way to attempt to frame that deficit. What we're seeing here on the right is, back in 2020, when stimulus bills passed in response to COVID, you see that deficit just blow out. Last year, too, we had more stimulus, but because the economy bounced back, the ratio came in. And then even with this new Inflation Reduction Act this year, we can still expect that these numbers will slowly moderate. History shows it's a normal pattern. In other words, we get these big economic shocks, even going all the way back to World War II, where government spending spikes, especially relative to the size of the economy, and then this ratio starts to come back in line. I would love to have surpluses again, but it's probably not realistic given how polarized DC has become. And okay, fine. We should still expect the deficit relative to GDP to improve over time. If we're being realistic, will these deficits reverse to the point where we see surpluses? No, it seems unlikely. Read into that whatever you will when it comes to politics. My point is that when it comes to investing, the irony here is that the best time to invest in the stock market is really when those deficits on here were at their worst, when you got those big red bars. Those points, when the economy was at its worst, also coincided with the times when government stimulus began to kick in. So again, here there's some irony in how we should behave around this for sure. And then, as that aside, I kind of hinted at earlier, that little dotted horizontal line at the negative 3% level there just reminds me of a Warren Buffett line, or maybe he wrote it or said it somewhere, and something to the effect of, I get to end the deficit in 5 minutes. Just pass a law that says that anytime there is a deficit of more than 3% of GDP, all sitting members of Congress shall be ineligible for re-election. Problem solved, huh? This is a chart just looking at market bull and bear cycles going back to the end of World War II. Kind of busy chart, a lot going on here, but the point is that while investors' attention and their worries and their concerns naturally gravitate more towards bear markets, they're never pleasant, and bad news gets more attention than good news in the stock market too. But I think this chart pretty strongly suggests that a better approach is to be prepared for the inevitable bear markets, and not in a way that would prevent you from taking advantage of or participating in the long subsequent bull markets that inevitably happen afterwards. So not only do bull markets last much longer, but the gains you will see in a bull market are typically multiples of what might have been lost during bear markets. If there's anything to be learned or known about markets, it's that they always adjust and overcome. Right now, the market, stock and bond side, is adjusting to new higher rates, but this volatility too, it will pass, and we can expect the market to stabilize and move higher again eventually. Bear markets, they're unavoidable. They're like the weather. The good news is bull markets last much longer, and you'll see larger returns, which I think is also important context and another hopefully reason to stay patient. And finally, ending here on another one of my favorite slides. This chart shows the effect of exiting the market for different durations of time immediately after negative 2% market days, immediately after days the market has dropped 2% or more. So in other words, all right, if the market drives me nuts and the day after it drops I decide to sell, how much could that impact me really? And the answer is quite a bit. Staying invested even when markets become volatile, it's absolutely critical to long-term gains. There's really no other way to say it. And deciding when to re-enter after you exit, it's just supremely difficult in the emotional sense and the analytical sense, and more often than not, it's just going to result in worse performance than simply staying invested in the first place. So this is just one more reminder when you're an investor, and this part is a big if and only if you are very picky about valuations, then patience can be a superpower really. That is it. That's all for now. I hope that was helpful. Covered a lot of ground. Apologies for coughing a little bit here. Please let me know if there are any questions or comments. And I guess I would close on the final thought that the odds of a good outcome in the market, even in the short term, are higher than it feels. And if that is true, then by extension, the odds of a great outcome longer term are even better. Valuations are important. There's no denying it, but I feel like that is hopefully one of the messages that came through here. Okay, thank you for your time, and please let me know of any questions or comments. Bye for now.